Okay, they got the closing bell there, so I guess we are live. Good afternoon, everybody. It is Friday, July 2nd, 2010, and the market's closed here. We had a little bit of strength there that tried to emerge at the end of the day, but it got rejected just in the last 5 minutes or so. You can see here that it was a pretty quiet session, and that wasn't unexpected. We had pretty light volume as compared to the 20-day moving average of volume and the most recent sessions here this week, except I guess Monday. That is Monday was pretty light, but for the week it was a pretty damaging event for the market, as we had seen last week. What was really important for the S&P 500 was when we lost that 111 area. Once we got below that 111 level, then we were looking for a move down towards about 109. Obviously, 109 didn't hold, and then we started looking at the weekly time frame for this Fibonacci level. Now, the Fibonacci level, the precise number, this doesn't draw it precisely, and it's really not meant to be a precise exact number, anyways. But the precise number was 101.11, and we had seen a low this week of actually 111 and 13 cents in the SPY, which is just kind of interesting when you consider it, especially if you look at some of this other Fibonacci that we've been talking about. From the high to this low, we had come up to last week, or 2 weeks ago rather, up to that 50% retracement. So the market first, and here's what we're talking about, is the high from this year to this year's low. We had first found resistance almost precisely at that 38.2% retracement, came down, tested the support, and rallied up to the 50% retracement. Well, that's when we dropped, and now we're looking at the weekly time frame. We're at that 38.2% retracement. So what is that? How do we extrapolate what might be next for this market? Well, we're down, what is this, 9 days in a row or something like that. The market is as everyone on TV and anywhere else on Twitter and all that says, we're due for a bounce, and I agree with that. We are probably due for a bounce. How high that bounce goes is anyone's guess, but what it might be setting up on the weekly time frame is just a little bit higher low, lower high, and then a move down towards the 50% retracement. So in other words, we might get a lower high, and we could even get up towards that 109 area. I think you can't rule that out, that we could get a pretty strong bounce, just to mess with the overconfident bears, just like we always mess with the overconfident bulls. The market swings harder in both directions than most people anticipate. So we're not quite ready to turn higher yet, but the next move might be down to this 50% retracement level, which also happens to be a prior level of resistance. Just like this 38.2% retracement was the prior resistance from late 2008. So we've got a lot of interesting things to look at in the market, and let me just go down to see who it was. It was Althus, Althus on Twitter, had mentioned to me earlier today, and I hadn't been keeping track of this, but it was a very good observation, is that the volume weighted average price since that March low, we're basically right on that as well, which further, that gives us now, really, if you look at it, we've got the 38.2% retracement, we've got this prior high, and we've got the volume weighted average price since this low. The average price the SPY has traded at is right down here, right at about 102. So you look at that, excuse me, you look at that, my kids would be laughing at me real hard right now. Because their voices are always cracking. But you look at that and you say, well, here are some important things, and I meant to draw this a little bit further out. Here are some important things that kind of come together in this general area, and that is the 38.2% retracement, the approximate this downtrend line that had been in place earlier, and that's where we're getting our support. But it's not buyable in here. You look at the 30-minute time frame, and what do we see? Well, we have a higher low in here. But that's not a reason to buy. As I've been pointing out, when we have a declining 5-day moving average, any long side trades should be day trades only. And that really made that case pretty much right in here at the end of the day, too, that you got to take those profits when they're there right now, because this market still needs to heal before it's able to going to be able to sustain some upward momentum. We had seen a higher low over here as well. That was last week. So very similar type of look to it at this point right here. And here's how we closed that day, and then we came in on Monday, obviously, or Tuesday rather, and got hurt. So a higher low isn't worth buying, and even a higher high in here I don't think is worth buying until we see this 5-day or the red moving average that we can get above it and really kind of hold above it, and it begins to flatten out. There's a lot of damage that's been done to this market. We broke a big level of support at that 104 to 105 area, so we would expect that this prior support would likely become resistance. We had a lot of negative information about the economy this week, from jobs, manufacturing, home sales, retail, and all that. If that's your thing to follow, but really the only thing that matters, as we know, is price. And price this week continued lower. Now it did make it down, like I said, to the 38.2% retracement. The Nasdaq, however, if we look at that, could still have some room to bleed down towards $41 a share, as that's the 38.2% retracement and a prior level of significance as far as support and resistance goes. So I still think the Nasdaq has the potential to make it down towards about $41 a share. We've got a pattern of lower highs and not quite lower lows yet, but if we get down to that 38.2% retracement, that's not when you want to short. We want to look for, I think it's prudent to look for a bounce, maybe even up towards about $44 a share in the Nasdaq, and then we'll see if another leg lower develops, and if it does, then maybe we're going to be looking at that 38 level or the 50% retracement here in the Nasdaq. A lot of damage done after we briefly broke through that declining 50-day moving average, and on a daily time frame, rallies with a declining 50-day moving average are generally guilty till proven innocent. So it's you can't trust these little rally attempts. As I said on a blog post this morning, that yesterday I had a decent day trading the long side, and mainly because of this little rally right here. We had seen it rally up to the VWAP, it pulled back to this little resistance, and I was getting long in here, and it just happened to work out well because that's what I was focused on. And if you're focused, and if you can stay focused and disciplined, there are good opportunities, long and short, regardless of what the overall market conditions are. You could have made money long or short today, but what's the path of least resistance on the bigger time frame? Still down. So you have to just go with what time frames make most sense to you personally. So back to the Nasdaq, we're still possibly going to head down towards that 38.2% retracement before we get a bounce. There's nothing, there's no evidence here that we're beginning to bounce. All we're seeing is maybe just a little bit of indecision with these shorter term moving averages crossing back and forth. But indecision is not a reason to buy or sell. Just like there's been some good work, and I had linked to some of the people who done them yesterday. I forget who. I know Weekly TA did a little study about the so-called death cross, and a couple other people did as well. Basically, though, the 50-day moving average crossing the 200-day moving average, it's not a good timing mechanism. It's it's something to be aware of, that the trend is changing. But realistically, what we're more interested in is what's the direction of that 200-day moving average, and are we making lower highs and lower lows below it, or higher highs and higher lows above it. So that's what we need to stay focused on. Don't look at these moving average crossovers as a reason to buy or sell. They are just simply much too long term to really matter, at least to the people that I think I'm talking to here. If you're a longer term investor, Warren, turn off StockTwits TV. You got no business being on here. I'm not talking your language. Anyways, the financials, same thing in here. We had seen a break of an important support level this week, and that important support level is right here at $13.60. We did close below it as well, and there's still the possibility that maybe we head down towards that 1280 level, the 38.2% retracement in here. This is obviously a pretty tough week, but we've had several of those this week, or this year rather, and if we get further flushed down to 1282, maybe that's where a rally emerges from. But right now, there is no evidence that a rally is setting up and trying to take hold in here, and just the opposite. We're seeing that the prior support at 1380 did become resistance here this morning, and it's got this little bearish flag look to it that it just doesn't look good. There's nothing here that looks good on any of these charts really on the short-term time frames. Best case you can make here on the SPY or the Qs or the XLF is that maybe we're starting to neutralize a little bit here, but neutralization is not a place to buy. You want to buy as price is not as price ranges are contracting. That means this is indecision here. We want to buy or sell short as prices are expanding away from a range, as they break a support level and then break lower. That's what we want to be looking for. So in the financials, looks like we could still do some bleeding here, down towards maybe that 1280 level. Russell 2000, also we looking here at the 38.2% retracement, almost precisely hit this week. And one thing I should also do in here is take a look at the volume weighted average prices off the lows, and same thing in the Russell 2000. Let's take a look at the financials from the lows. We could take a look from March. Okay, so that's kind of interesting that. In fact, that's real interesting. On the NASDAQ weekly chart, the volume weighted average price from the March low is right here at this line right here that intersects at about $41 a share. Since the real low in 2008, the average price is right here, closer to that 50% retracement. So that's a pretty interesting thing that those two levels come together in the same spot. Anyways, let's take a look back. We were looking at the Russell 2000. The Russell 2000, we had seen that from that failed break past resistance at $67 a share, did in fact come a fast move, a little bit of recovery, and then another leg lower. We're down into that 38.2% retracement, still holding above the lows for the year, but most importantly, we are still below that declining 5-day moving average, and we do still have a pattern really of lower highs and lower lows. Now that could change next week. This became more neutral than anything in an inside day today, but that's just just reflective on the daily time frame of indecision, what an inside day is, where we have the entire day's range within the prior day's range. So it means that some people will say that means it's a reversal. It's not a reversal area until prices start moving higher, and in my mind, until we see the 5-day moving average flattened out and prices are able to hold above it like we had seen back in early June. The semiconductors last week or on Monday got up to that resistance just at about $27.60 and that declining 5-day moving average, and they got rejected hard away from there. Lower highs and lower lows, more maybe neutralization in there. If you look at the weekly chart in here, then 2450 looks realistic, and I think if the semiconductors get there, you're going to see that these the Qs definitely get down towards that $41 level as well. So still not a reason to be a buyer in here. Gold this week we had some selling in gold. It bounced back a little bit today. Longer term, if you're an investor, and as I had tweeted, I had bought some coins. Actually, I remember because it was right around here. I thought the market was stabilizing, and then I wrote it down through that, but I just sold them this week, and it went from $900 an ounce to $1258, or 40%, and that's the longest I've held anything in a long time. But they did break down hard. So I'd sold Monday. They did break down hard yesterday. Gold, that is the metal. and held right at this little level. We got a little bit of a reprise today, but we're below a declining 5-day moving average. I would say you want to be careful with gold. It's got this prior support, which looks to be acting as resistance near that 119 level. And I'm not thinking that gold will just completely fall apart here, but it's had a hell of a run, and it's seen. An Elliott wave person would say drive one, drive two, or one, two, three, four, five. I don't really look at it that way because people end up scratching out the one and say, or the two, and saying no, that was a 2B and then a 3A, etc. But it's had a great rally, and I'm basically done with it. It just seems more neutral than anything. Silver probably, silver has been neutral pretty much all year. Still holding its longer term trend line in the 200-day moving average as well. So I'd say silver is probably more neutral than anything. The gold stocks, which I had written an article about on Monday, and as I said Monday afternoon actually to subscribers, that when it broke down here, I said forget it. Forget this gold thing. Forget about a stop down at 5140. That's just too far away to really make sense. It did get through that 5140 level that I was saying that if you were a longer term swing trader, that a stop should go below here because they were looking bullish. But you know what? That's where people say, well, technical analysis doesn't work. It looked bullish this day, and then you changed your mind. That's called money management. It's called common sense in listening to the message of the market. Did the fundamentals change in 5-6 days this week for the gold for gold or for the gold miners? I don't know, but you have to follow price and listen to it, and take your little lumps when you get them and move on. That's what trading's all about. The retail stocks, these ones have really kind of been hit the hardest from the April highs. They've really experienced a lot heavier damage than a lot of other areas in the market, and they're still below that declining 5-day moving average as well. Maybe showing a little bit more signs of stability. They were, if you remember, they did close with a gain on Thursday. Today they were obviously just down a little bit, down 80 cents or about 1%. We still have that declining 5-day moving average. So yesterday, had you been trading, yeah, there were some good upside moves in there, but the trend on the daily time frame, the trend on even the weekly time frame, you can see here what happened is they sliced right through that 38.2% retracement. So the point is, even with with the Qs and the S&P and that sort of thing, is we look at the market attempting to stabilize at a 38% retracement. There's nothing to say that it will hold there. What we want to instead be aware of is while we're below a declining 5-day moving average, the market, well, let's just go back to that weekly time frame. So this was at about $90 a share. So at about $90 a share is where that 38.2% retracement was for the retail holders. Well, they were still below a declining 5-day moving average. So the people that were buying based on Fibonacci, in my mind, were buying still during this period of uncertainty. And what we wanted to see, if these retailers were going to recover, is that price action would have done something like this, and then it would have dragged that 5-day moving average. Instead of lower like that, it would have gone something like this and begun to rally. So that's what you would have been looking for in this area at the 38.2% retracement. And that's what we're going to maybe look for to occur with the NASDAQ and with the SPY. But right now, we're still maybe at this area. Right here in the retail holders, maybe that's where we are in the Nasdaq, and maybe that's where we are in the S&P 500. Just because we're at this 38.2% retracement doesn't mean that this market has to bounce. It didn't bounce there for the retail holders, and there, if you look at multiple time frames, you look at this weekly time frame, and you say, okay, well, this is an important level. It was prior support. That's a big area, and now it's at that 38.2% retracement, and it seems to be stabilizing in here at $90 a share. So do you go in and buy? No, you wait for a pattern of higher highs and higher lows to emerge. You wait for that 5-day moving average to flatten out, and then you want to get involved with a stop underneath these higher lows, because the daily time frame is still obviously quite damaged here. And anyways, this is the retail holders. I bring these up because they represent really a great lesson for what might occur in the S&P 500. Doesn't mean it will, but it's a scenario that you have to consider, and it really shows why you can look at this market and say, hey, it's down a lot, it's down X many days in a row, it's down too much, whatever. But the fact is, the sellers remain in control, just like they remain in control of the retail stocks. The retail stocks are down a whole bunch. Well, they can keep going down. That's, there's no limit. There is a limit, obviously, to how much they can go lower. But in the retail holders, next week, if we kind of run up towards this area, then create a higher low, maybe we can get above 87.5, and that 5-day moving average begins to turn higher, and then we could see a rally that up towards that 89.90 level, and that would be worth trading maybe, or you'd instead wait for that rally to dissipate, turn sideways, and then you would want to use it as an opportunity to get short. So anyway, it's up to you how to do it, obviously. I wanted to talk just real quickly about Tesla. Only because Tesla came public this week. And if you look at, here's the volume weighted average price each day. So this is where right here, the average price in the aftermarket, now it's not counting the whatever it was priced at, I think $17 a share, but that's exactly where the sellers really got a hold of this deal, was when it crossed that line on the cumulative volume weighted average price. On the 30th, let's take a look at this on the 30th, because this was pretty interesting, and I know that some people that I know were trading. I took one trade and I didn't hold it very long, but on the 30th, was that right? The 30th, is that what I'm thinking? The 30th, yeah. I had purchased it right in here near the VWAP, and I know somebody else told me they had bought it in here, but it was making some nice bounces from the volume weighted average price, and that's just the psychology of the day, basically, is the way you want to look at that. Anyways, let's go back to, let's just put this back where we are, which is the 2nd of July, and anyways, let's so we've had damage done in a lot of sectors. Apple looked like it was breaking out 2 weeks ago, and from that failed move higher came this fast move lower. And a lot of people look at Apple and want to buy it at the 50-day moving average. We talked about this on Wednesday, but back there, what was the direction of that 5-day moving average? The market was stuck below and a declining 5-day moving average, and it still is. So as far as Apple goes, because people ask me about Apple a lot, no, I wouldn't buy it. I wouldn't suggest buying it here. It's just it's still in this short-term downtrend. Let's see. Tom, Michigan, wants me to take a look at SMG. And this is the only one I'm going to look at. I'm just it's a holiday weekend. Let's end it. It looks neutral on the daily time frame, on the weekly time frame. Kind of, it's probably going to get back above here to get moving higher again. Longer term, it does look like the buyers are in control. But anyways, everyone asks me about ABC every single week. But you know what, guys? I'm done here. It's the end of the month. It's the end of the course. It's the beginning of the month. It's the end of the half this year. And anyways, beginning of a long holiday weekend. I hope everybody enjoys a fun and safe holiday, and we will talk again on Wednesday. Don't forget the market's closed on Monday, so have a great weekend, everybody.